So let's start with the assignment. Let me go over it. The assignment is when you go to the courses, corporate, business corporate valuation, you get to this one. And right after the last section, we have the assignment. So this is basically the assignment. Does anyone have any specific question before I dive in? I changed it slightly. I moved what was number 1, I put it as number 10 in a minute, so I'll get back to that. And I will also show you how you do number 10. Unfortunately, the recording of last week, for some reason, the Zoom didn't really convert it right. So unfortunately, I lost the recording, which is really rare because I have a professional Zoom. Shouldn't have happened, but so I uploaded a recording, a special recording for the relative valuation. So you do have at least a recording on relative valuation. Unfortunately, we don't have the whole session. And what do we need to do? You know, basically, it's really taking the assignments of what you have done so far, including the last one, which is relative valuation, okay, and organize them. But I would put some emphasis on how to do it, okay? So first page is first page, basically. And then I think all those up to point 4, they are kind of obvious. Introduction, I recommend to write in the end when you finished, okay? Let me explain the SWOT. In fact, you can use what you learned from other classes. And I mentioned it's very important for this course, but that's not what I'm going to cover in this course, and that's what we did. So, okay. So number 5 is really the first one to follow. And what do that mean in number 5? Number 5, I ask you to do the cash flow for the firm. And what did I mean? And how do I recommend to write it, okay? If you go here, let me go into another one. So it will be easy to go and switch between one and back to the simulation. Okay, let's take a company. I think we used Amazon, so let's stick for Amazon for whatever. It doesn't really make a difference. Anybody wants to use another company? I have no problem.
It's fine.
Lionsgate.
Which one?
You can use Amazon. Use Amazon.
Amazon good enough? Okay.
Yeah, it's okay.
Yeah. Okay, let's use Amazon. It's the United States. And we have, let's say the last year we have data for. Then Amazon we used, you know, we said it's a computer services. They have something even, you know, what did I say? It's computer. I think that's what should do it, using computer software. I think according to another student from another class, they checked that it's about 61% of their business. The second part, as I understood from there, it's retail, and you have internet retail. And those two, more or less, this is about 21, and the rest is general. So we ignore that.
Is this for Amazon?
Yeah. Do you know the numbers?
I can tell you right now the betas that we did. I can give you the
Yeah, go ahead. That will be good.
numbers. 1 second.
That's for sure. There is retail internet.
That's what I was told. It makes sense. That's what they do. I mean, a lot from Amazon.
But only 21%. I am.
Correct. That's what I understood. Exactly. It's not a major one. And that makes sense because this is really taking over. That's what they're really making money too. They never have made money out of the retail.
Okay, so I have the percentages. For internet retail, we calculated 81% of their business.
This is 81? Okay, go ahead.
Computer services, we calculated as around 12%.
Okay.
And retail, grocery, and food, we calculated around 6%.
Hold a second. Retail.
Grocery and food.
Where do you see that?
Right there. You
Yeah,
just
here we
passed it.
Yeah, excellent. Okay, that's how many percentage?
6%. But
Six. How many?
yeah, 6%.
Six.
But in the
Ah, six.
calculation, we rounded up one of them just so it would be easier. They're
Okay.
both like
81, 93. Yeah, let's do 7. That will be fine. Or make a much different. Beautiful. So really we're getting the weighted average, the weighted average of the beta, we're getting the weighted average of the growth. And those numbers really go into here. And in a minute we'll get to them and talk about it. Okay? But basically that's the information we need in order to use the simulation. Your objective in the paper is to make sure that when you're writing this assignment, you show that you really understand the company and you understand the valuation process. In fact, you have the whole process done for you, but you need to show the understanding. I will explain. For example, in 5, future 5 years cash flow of the company plus the 6th year steady state. Okay, what do I mean by that? If you go over here, you are going to valuation, you will see in this section, you have the calculation of the cash flow. We have the cash flow right here. The truth of the matter, I kind of changed my mind. I think in future, when I update this version, I will remove the terminal value from here. I think it's a little confusing. And what I would like you to do in the paper, just, for this section, you can put the whole things here and end up in this row, like the cash flow. What I would do, remove the terminal value out of here altogether. And here, just plug the number, this minus this minus this, will give you the cash flow for 2025, okay? This is really the first year of the steady state period, meaning from that amount, it's gonna grow by 2% every year. I think it's a better representation. I think this one a little confusing to plug it here. So later on, you can take this number, I will put it right below this one before you add it. So I will do this line, okay? And then after this line, I will take this line and put it behind it and add them up. I think it will be clearer. It's a little confusing the way I did it. So I will do steady state cash flow will be this one. That's the EBIT minus taxes, minus reinvestment of capital expenditures. That will give me a cash flow in the steady state. Here I will take this one away, and this one will be exactly like the other years. This one minus this one minus this one will give me the cash flow of the 5th year. Below that, I will move the terminal value. Should be really, I think it would make more sense to put it below the cash flow and then add another row, adding those two together. That looks to me clearer. I don't know, I was debating with myself many times, but whatever you feel more comfortable, you're more than welcome to do it, okay? But the idea is that, go ahead.
Yeah, can we take like the snipping tool and take the kind of a screenshot of that and show it in the paper and then explain each calculation?
Definitely. Yeah, it's
Okay.
very good. In fact, for this section 5 and the other one, you can screenshot. In fact, I said, if I were a student, I most likely would take this one away from you. The more I think about it, I shouldn't have put it there. I'll put it below that to be clearer. Then I will have really the cash flow and the steady state. I will do this minus this minus this will give me the cash flow of 2025. That's the first year of the steady state, Then after you did the screenshot, you can move it a little bit around. And then you can also explain later on, we'll see in a minute, we'll get to that. But that's for the cash flow. Explaining, when you do that, you should explain that this is the EBIT of 2019. We believe this is representing the best EBIT of that year. And that's going to grow by the percentage calculated by the short-term growth. This short-term growth, we have it in the calculation. That's one based on analyst. So that's 5 years forecast of analyst. So we have the growth right in here. So you can take a screenshot of this one and explain what we do here. So because you're using the 4.3 or 4.9 or 4.4 almost percentage, we use this number right in here. And then this number, we're really calculating the EBIT, forecast of the EBIT for the following year. You should also emphasize that from 2024 to the following year, we use the growth rate of the steady state, which is 2%. And again, emphasize that this is the estimate of the GDP of US, okay? That could be a good sentence to add there. Then we calculate the taxes. Taxes is based in the short term, based on the effective tax rate. And in the steady state, the way we calculate this number, it is based on the marginal tax rate. So how did I get 3859? It's really simply 21% of the 183, this number, okay? That's the way I calculated that one. How did I get the net capital expenditure? Again, I used the reinvestment rate that we calculated based on short-term rate divided by the ROIC. And here it's also a place when you talk about, when you talk about capital expenditure, I will divide it. First, I will talk about the estimate of the short-term growth. I will talk about ROIC. I will take a screenshot of this part and say, based on this analysis, it is 9.44. And that's the way we got the number right here. And based on those two numbers, this divided by that give me an estimate of the reinvestment in the next 5 years, okay? Now, what is this one? What this number helped me? It's the percentage that I multiply by 1 minus t, this minus this, times 46%, give me this number. I'll take even 1 year and show the calculation. That's a good explanation, okay? That's really supposed to answer section number 1. About the WACC, you can say we use the WACC later on. You see, this has come right after 5, yeah? We'll get to that in a second, okay? But WACC, let's see what do we have in WACC. In the WACC, if you notice, you have a special section, you're supposed to discuss WACC. So this one I will do also a mini chapter, calculations of the WACC. How would I present it? I will go here and say, okay, our calculation shows WACC of 7.19. That based on our calculation of the cost of debt and the cost of equity. And then I'll take a screenshot of the debt. Go ahead. Anybody? Okay. So here you discussed how did we calculate the cost of debt? Okay, so talk about it. We use the interest coverage. Based on the interest coverage, we have the rating of the company, and then based on that, the company default rate is for 0.4%. You're adding all of those together, it comes to be 2.4. Since this company is United States, we do not have any country default risk. Some of you can say, you can use even example like that. If the company, most of the business of the company was in United Kingdom, for example, there will be also a default, country default risk. And then we should calculate and add that part as well, okay? That's something you can add. It's a good for the paper, but for really doing the work is fine just to show that there's no risk for a country risk because US consider the AAA very low risk country.
But if the company is operating in a lot of different countries, we don't have to show for different countries.
You're right. That's what I said during the semester. My next version of this simulation will be, I will take this one away from here, especially the spread, okay? And I will make something similar to that just for the country risk. So if you're operating in several countries, you really should do a weighted average. For now, I'm just giving you the simple case just to choose the country of incorporation. It will be good enough for now. You know what I mean? It will be better if we could split it by the countries in which the company doing business and estimate the country risk of every location and then do an average or weighted average. But I'm not asking you to do that for the paper. It's enough to use United States, but just emphasize, at least in the discussion, explain that that's what you should do in real life, okay? Okay, that's relating to the death cost. Then you talk about how we calculate the cost of equity. Basically, you explain that we use free industry. We're doing a weighted average of the unleveraged beta. We're getting unleveraged, weighted average of unleveraged beta of 1.09. We're converting it to a leverage using the debt to equity ratio. And one of my slides, you will see there is the formula. Let me see if I can find it easily. Let me open another one. I think it should be here. Let's see, I think it might be even here. No, it should be down. But I think it should be here. Maybe the last one. Let me see. Yeah, here we go. In this slide, I went over how to calculate the weighted average for using comparable companies. And I said, this is the most important equation. I will give it to you in the exam. You don't have to memorize it. But how do I convert unleveraged beta to leverage beta? I multiply it by some factor. And if you notice, it's 1 plus 1 minus 3 times debt over equity. So the more debt I have, the company considers riskier and the beta will be higher, okay? So you need to use this equation right in here, sorry. Right in here, the way we're converting from 1.08 to 157, it's really, I will advise you to show the calculation. You take 108, you multiply it by 1 plus 1 minus 21%, which is the tax rate, times the debt over equity. And all the data you have right here. So you can find the total long-term debt, you have the total liabilities, and you have the total equity, okay? So you take this number, which is important, and if I recall, this is the number that you need to use. This number divide by this number, give you a ratio. You take that ratio, and you multiply it by the unleveraged beta. And that's the way you get to 1.57, okay? Okay, after you explain the beta, you say just basically you calculate the cost of equity based on the CAPM, okay? And the CAPM tells you to take the leverage beta times the risk premium, okay? And that gives you the 10 point, or 20, sorry, you add to that the risk-free, you get the 10.23. If you operate in risky countries, you have to add also country risk, and the way we add country risk, okay, let's use the United Kingdom again, and we have some risk, 0.04, and you can use that as explaining how that should work if the company was operating in a riskier location. And we talked about it in class. We take the default spread, and then we adjust it to the fact that the stocks are more volatile than death. Therefore, we have to do adjustment for the risk. So we take the 0.4 and multiply by the ratio of the standard deviation of return on the stock index versus the index on bonds. And that's one, it's about 1.5. I gave you that number. That's very quite representative of what really happened in the last several years, many years in fact. So 1.5 times 0.04 give me that I should add to the risk premium of 525, I should add 0.6 to the 5.25. After I add it, the rest of the calculation are the same. I take the beta, multiply it, and add the risk premium, the risk free. All of that will give me 11.09. Okay, I got the cost of equity, I got the cost of debt, and now what we're getting, 7.83, should be equal to the cost of debt times the share of debt, meaning debt over debt plus equity, plus, if I go here, I take the 2.8, multiply it, okay, by 1 minus t, multiply that by debt over debt plus equity. That will be the part of the debt. And then I will do the same things. I take 11.09, multiply by the equity, divide by debt plus equity. You add those two together, you're basically getting this number. That's the section on the one. It's a very important, this number is one of the most important number in the valuation. And we'll see it in a minute, okay? So answering the question of 6, it's really the discussion we just talked about now. And you know it's about your company, okay? Questions so far? Anyone? Is that clear?
Yes.
Okay, wonderful. Let's move to the next one. Estimation of all variables. I wasn't clear enough, and that's very important that I will go over and explain that in more detail. Estimation of all variables, use the simulation and give explanation. It was really vague. I should really have written it better. What did I mean here? What I meant is, if you notice, there are several parameters that they are affecting the valuation. So this one, we have a whole section. But really what I would like you to do is explain how did we get the effective tax rate? We're going to use it. We use it for the short-term taxes. Is that right? For those years, we're using the effective tax. And then you really, I would recommend when you explain the effective tax rate got 17.91 based on our calculation of the last 5 years. We took the actual taxes relative to the operating income, and that becomes to be 17.91. By the way, I used here a method which is less volatile or more stable. It's instead of doing one divided by the other one, if I take this one divided by this one, I will get the effective tax rate for 2015. The same if I take this one divided by this one, I will get the effective tax rate for 2016. And the same for every year. So somebody can ask, why don't you do that and then take the average? Well, that's happened to be that this one will have a higher variance. It's a better way to do it. By the way, you can have fluctuation in taxes. Some years, the company might not pay any taxes just because they postpone taxes to another years. So to avoid it, you take all the taxes for all those years, you add them up. You take all the operating income, you add them up, and then this number is much more stable. Okay, you take the total of 5 years, divide by the total of 5 years, that gives you a better stable number. Okay, so that's what you do is explaining effective tax rate, and then you move on to the next one, return on invested capital, like 9.44. How did we get that number? So again, you can take a screenshot of this one and explain the 9.44 based on an average of the last 4 years. And the way we did it, we just took the operating income, okay? We took the total of over 5 years, and then we divided that one by a long-term liability plus the equity, okay? We take the long-term liability plus equity, and in other words, I would take the total here, divided by the sum of those two, long-term liability plus equity. That's one, give me 9.44. Okay, that's return on investment by definition. Total operating income after taxes minus the divided by total debt plus equity. Okay, that's a good one. And we assume that that's what's going to happen in the future as well. Now, way to check yourself, you say, well, let's see if this one have changed over time. What about if I move that to 3 years? Why this is higher? How about if I move that to 2 years, only the 2 years? Why it's even higher? That means that really Amazon, it starts stabilizing in the last 3 years, 201. 1, it's even went down a little bit. If you take 2 years, it's a little higher. You take 3 years, it's quite stable around 11, 12%, something like that. Okay, and in a minute we'll see how sensitive our valuation is to those numbers. But I can say if I use, something between 9.5 to 12, I'm probably doing okay. Put it back to 5. Over the last 5 years, it's 9. So if I use 10%, it won't be too bad because I see that in the last several years, they have even 12%, okay? Are they gonna continue 12%? We have seen that the last year was lower than the year earlier, okay? And we'll discuss that in a second. But basically you explain how do we do the calculation here, and we got the 9.44, and that 9.44, it is really the ROIC we use here in the valuation. Now, everybody should know that the reinvestment rate is really the growth over the ROIC. We covered it in class, and that's the way we calculated the reinvestment rate. And we already have seen before, we use the reinvestment rate to calculate how much we should spend in order to have this kind of growth in the short term. The next part, and the last one, just explain why we use 2%. I talked about in class, that should be more or less estimation of what we expect the GDP in the whole country to be. And then we said the ROIC must be equal to the WACC. Otherwise, or the company will shrink relative to the whole economy, or the company will just blow up and will be the whole company. So you can't really put any number different than the WACC, because otherwise the whole economy in 100 years will be just this company, okay? That's another point we made. Then when I take this one divided by this one, I get the reinvestment rate for the steady state, and we use that in calculating the net capital expenditure for the steady state. Okay, that's really mean explain the variables. Everybody clear on that part? In a minute, I'm going to talk about sensitivity analysis.
Just for the
go ahead.
Just for the marginal tax rate, you took it from the last year, right? From the 2019, right?
Exactly. This is the EBIT is 2019. Which one are you talking about? Sorry.
The marginal tax rate. It's from 2019,
the marginal tax
right?
rate is the statutory tax rate in the US. In this example, now I changed it to the UK, but I really should go back to the United States. I was demonstrating. It should be the 21%, because that's really the tax rate for Amazon. You're right. It's a marginal tax.
That's the actual that they have paid during 2019?
No, this is what they should pay if they would pay the marginal tax rate for corporation. That's really what we know as the statutory. Okay, but for accounting, many times you can postpone some of your taxes because you get some benefits, or you get some accelerated depreciation, reduce your taxes for that year, and postpone it to other years. So but on the steady state, you can't really change it over time. If you look from now to infinity, the underlying assumption that this is going to last forever. And in minutes, I'm going to talk about it more in detail. I'll show you how I modify it to feel more comfortable with my evaluation. For now, we use the statutory tax rate for corporation in 2019. Okay? Good. More questions, guys, before I move on? Let me just show okay, estimation of all variables. That's what I meant. Now, what I wanted you to do is to give explanation. Here we did, and we gave some explanation of all the variables. That's really number 7. So we basically covered number 7. Now we want to complete number 8. Okay, how do we get the cash flow? I made some comment before. Now it becomes to be easier. If I were a student, I am going to change the Excel here. Won't make a difference, but from presentation point of view, seems to me will be clearer. I'm going to take this row, put it below the cash flow, and then just calculate this minus this minus this will give me exactly the number also for 2024. I do the same for the steady state. I recommend to move the terminal value right below that, then you add them up. So basically this is going to be the last row anyway, just change here a little bit the presentation, but the numbers will not change. So this is my cash flow, okay? Now I want to discount it. I will do the discount factor, which is really the 0.93 is 1 over 1 plus 7.19%. One more time. How did I get 0.93? Simply, let's use it in Excel for a second. So if I go into here, I will put equal to 1 over 1 plus a 0.0719. That should give me 93%. That's about 93%. Okay, this is just rounded probably. Okay, good. So how do I get the 0.87? It's just the same number, just square. So if I take the same number, power 2, and that's you learn in finance. Yep. Time 2, that's what give me, and etc. This one times 3 times 4. That's the way we calculate discount factor. Okay. Okay, we have the discount factor. We multiply it by the cash flow. We get the net present value of every cash flow as if it was paid in 2019. We add them all up. We get the present value. That's the value of the debt plus equity, plus if we had minority interest. Remember from the session we studied about acquisition. So that's the value of all those together. So if I want to get to the value of the shares, I must take this value, subtract from it the debt, and then I get the, if there is minority interest, I have to subtract it. If there are preferred stock, I have to subtract it. And then whatever come out, I divide by the number of shares. That gives me the value per share. That's what's supposed to be, based on our valuation, the value of the shares of Amazon. Of course, we see a difference, and then we're going to discuss in a minute. But that's what I expect explaining the discounting cash flow mechanism. It's calculating the discount factor, multiplying by the cash flow, adding them up, and subtracting debt and other component to get to the value of the total shares, divided by number of shares, we get the value per share. Questions, guys, before we move on? More questions, guys? Everybody happy? Hello?
Yeah.
Good. Oh, let's see. Let's see your faces a little bit. You know, it's this last session. Let me turn it on. Yeah. Sasha, how are you? Doing good? Everything is clear?
Really good.
Good.
Yeah,
you
it's
understand
clear.
everything? So if I put a
just
question
not
in the exam, if I put a question in the exam, giving you the data on the top, you'll be able to fill up all the numbers here, yeah? I know.
I probably need to go over it a bit, you know?
Exactly, but there's nothing that you're scared of. That's the most, yeah, definitely. You have to
Yeah.
review that few times, no question. Good.
And terminal value, how do you calculate it?
Or terminal value is really, you take the 18th, 183 and all those numbers, you subtract taxes, you subtract net capital expenditure, you get a cash flow for 2025. You take that number, you divide it by the WACC minus 2%, which is the growth rate in the steady state. That will give you the terminal value. So we went over that in one of the sessions. It's good for review. You know, if you go over the videos, you will see we discussed that. That's a good question too. Make sure you know that, yeah? Don't get lost. Don't make mistakes. And the most important, I notice many students make the mistake. When you move from the EBIT 2024 to 2025, they use the same number here. No, from here to here, you should use the 2%. For calculating the taxes, you shouldn't use the effective tax rate. You should use the marginal tax rate. So how do you get this number? This one is basically 17.91% times this number, okay? Don't get confused. Don't take the 21%.
No, okay. It's 21%, you say, not
correct.
effective.
21% for the steady state. So this number is 21% of this number. When you do for the other years, how do you calculate those numbers? Let's say this number, how do I calculate it? It's effective tax rate times the EBIT. So this is different. Here I take, for taxes, I take the effective tax rate. For the steady state, we use the marginal tax rate. Don't get lost. Then when you calculate the reinvestment rate, when you want to calculate those numbers, you use growth rate divided by ROIC, you get the reinvestment rate. This number we use only for the first 5 years. For the steady state, we do this one, divide by this one, we get a different reinvestment rate. This is the number I multiply by this minus this to get this number. How do I get this number? I take this minus the taxes, and whatever come out, okay, I multiply it by 46%. That's what give me this number. Fair enough?
Yep.
Good. So don't get confused, you know, don't miss any point in the exam. If I give you a question like that, which I might, I like to give questions like that. Okay, you should know it immediately. You don't need to think about it. You should really memorize, really understand the logic, and we went over that in class. Wonderful. Okay, now that we have this one, let's move to the next point. Okay, 9, perform sensitivity analysis. What do I mean by that? And I'm going to give explanation of the results. So let's do it. I'll do it for Amazon, and I will tell you what I expect. Do something similar for your own company. So what I'm expecting you to do. 1, see, we see a big difference. You know, the valuation is 268. They're almost, 1,800 above, almost 1,900. You know, that's a big difference. What might explain it? I might have made mistakes. Maybe my assumptions are too naive. So one thing we know have effect on the valuation is the WACC. Based on our calculation, it should be 7.19. But let's say I want to see, is it really the WACC? If I remove that to 6%, the market value should be much higher, okay? Let's see how much that affects the valuation. So here I'm doing really sensitivity analysis, but we're going to do something a little more elaborate in a second. But as a first round, yeah, it did affect, but I didn't jump it to be so high. So I kind of reduced it. That means Amazon can raise money in a cheaper way. Even though they will raise money in cheaper way, still the market value of that equity will not go up. Moreover, I said the effective tax rate was only 17, almost 18, even in years in which the tax rate was much higher than 21. How about we say, let's say the Amazon for some reason will pay less taxes in the future. Will that increase much their valuation? Yeah, it does, but not that much, okay? So that can't be really explained. How about we said that never will pay taxes? That's unreasonable assumption. But is that going to be able to explain why it's being traded so high? No, it doesn't. Say it's jumped big time, but far away from whatever it's supposed to. This is very unrealistic assumption, but what does it do is that if somebody would try to tell me, well, your valuation is far away, say, no, my valuation is not that far away. I'm making even very favorable assumptions about Amazon, still I'm getting that it's not that high. So it's probably overvalued because of other reasons. If you really want to look at the merit of this company, it should be lower than 463 because they're going to pay some taxes. No way they're not going to pay anything. Moreover, let's say maybe the analyst estimate of the next 5 years is too low. How about I'll put 10%? See, this is also really going out of the blue. How much that going to increase the value? It's went up, but not, it's still less than a third, okay? So I'm really moving and I'm doing all the stuff that most likely it's not going to happen, but still try to see if that's the reason. How about this one? They're growing every year 9.44. How about I would change this to 15%? That's also very, very high. I doubt they will get above 15 for the next 5 years. Still, I still less than a third in my valuation. All that does one thing, makes it more comfortable for saying a statement like that in my summary. I can summarize eventually and say, based on our valuation, the stock price of Amazon most likely is overvalued. I will phrase it carefully, most likely, because you never know. It might be that we might make some mistakes or our estimate going to be proved to be wrong and they will go even faster than 15%, but it's unlikely, okay? So that's why we use the word unlikely. Moreover, if I really want to get crazy, I put 25%, okay? That means that, you know, is that still give me, yeah, it's high, but that's not the one that's going to explain it. So let's go to more realistic numbers. Let's put 10% here. Short term, let's put back, it's even 6%, that's fine, okay? But that's more or less realistic. I push that, it's above realistic. That's sensitivity analysis, but we want to do better. How about if we assume that this one, it's about 6%, but it could be plus minus, could be 6.25, could be 6, could be 5.75, could be many numbers. And that one can be many numbers. And I want to pick up random numbers. You know, there are 6 major numbers that are affecting the valuation of the equation of all this spreadsheet. How about I pull 100,000 random numbers around those numbers that are affecting the valuation? What will look like the distribution of my valuation? That's really what this simulation does. When you click on this button, you run 100 times. Why it doesn't like me? Maybe I pushed that too much. Let me see. I think one of the numbers I pushed that too much. Let's just put that one, 5%. 5%. Let's see now. Yeah, okay. So I did that 100,000 times. So that's more or less the distribution of what I'm expecting. On average, it's supposed to be around the 450. But it might get up to a level to, let's say, push it a lot, 550. So it's unlikely to get to that high, okay? And other things we have in this simulation, when we're drawing randomly, we're drawing that from similar to a normal distribution. But how about if I push the distribution to be picking more higher number than lower in normal distribution? So it's more likely to get more than 6 than numbers below 6. Some things I will do all the other one. What will look like then? That's the skewness. You might know what the skewness mean. That means I will get more higher numbers than lower numbers in my parameters that will affect more positive. I'll run it again. Now I'm getting, it might get to 600. Still, it's far away from 1800. I feel much more comfortable. You see, it has a little bending to the right. It's not exactly symmetric. Gives you more higher number than the lower, but still, I don't pass the 600, okay? Another way you can say, well, you know, when you're putting the distribution here, you're assuming some range of this distribution. Let's increase the range. Let's see, I can pull higher number, a lower number more. Let's put it 0.2. That's like, I have a bigger variance to every one of those parameters. So what might be now look like my distribution. When I click on it, see it's opening a bigger range because numbers can be very favorable or very bad. So I will increase the range. So I'm trying to estimate what might be the range. I mean, maybe it's more than 0.3, very unlikely, okay? So I run it again. Yep, yeah, I knew that. That's why it's put 2.9. That will be better, it will do it. Yeah, okay, still it pushed it. So if I give it a bigger range, okay, I'm not passing the 1,000. I still far away from the 1847. So the conclusion of this is called a simulator, okay? Many years ago, not many years ago, in fact, a couple of years ago, I used to use the Excel. So I had the student to download a special component. Luckily now, you really have it right built in. So you just need to understand what does it do. What it does really is picking up 100,000 numbers, a vector, in fact, 100,000 times this one, 100 times this one, 100,000 times this one, and it pick randomly numbers around those ones and do the whole calculation 100,000 times. And that's the range that you're getting. So after doing that one, I'm quite comfortable. It's most likely it's overvalued. Okay.
Can you speak more about the range? What does 0.29
yeah, let
mean?
me explain. Let's say the WACC is 5%. You know, the value of the company is higher. You agree? If I take this one to be 5.5, it will be lower. Is that right? You see it's lower.
Yeah.
You take 5.75, you get another number. Is that right? You get a lot of numbers. If you do it 100,000 times by hand, your hand will hurt you. So you can make the computer, you know, do it, pick numbers around the range, you know, of plus minus within the range of 20%. That's what we're doing here.
So plus minus
almost 30%.
29.
Exactly, 29%. Exactly right. So it's picking up numbers around this one. So if I put here 6, that was originally, okay. How much was it? How much was the number here? Wow. Anybody? Yeah, let's do Control Z. Yeah, that should be, we did 6%, yeah. Okay, I'm picking up 100,000 numbers around the 6%, plus minus 29%, within that range. So it's picking up randomly 100,000 times a number. It does the same things for this one, plus minus 29%. Does for this one again. After he's picking one number from this, one number for this, one number for this, one number for this, one for this, and one for this, he does the whole calculation again, and you get a number. Then you do again, you fill up another set of 6 numbers randomly, the same way. Calculate the valuation. It does it 100,000 times, so basically you have 100,000 lines here, okay? You add them up, and you get a little curve. So many of the cases are around, you know, when you do the valuation, most of the valuation are about 685, okay? And sometimes, you know, when the WACC is very low, the growth is high, you get a valuation higher valuation. But very few cases, this is why the chart is low here. You know, you have very few cases in which you get to 1100. Most of the cases are around the 600, 700. So I can say very unlikely that Amazon is being traded for its own real intrinsic value. It's most likely.
And the skew? And the skew? What do you mean by skew?
The skew is, say, I can pick up numbers plus minus 29% randomly. But when I change the skewness to be a higher number, it will pick up more numbers above 6 and less below 6. You got it?
Okay.
In fact, in
but
this
it
case,
will
the other way around.
30% more? You mean it will, in
No,
that case, it's 3.
you know,
So
you can pick up numbers between around 6, yeah? In this case, if the skewness is 3, I can pull up plus minus 30%, that's the range. But if I put skewness 30%, it will pick up higher probability to pick up lower number than higher number. It will be able to pick numbers in the whole range. Let's say between 5, how about, it's about 4.8. That's the range it will pick up to, I would say 7.2. That's the range, okay? That's plus minus 30%. But it will pick up numbers from here, it will pick up numbers from here. But if you change the skewness, the way I did it, the higher the skewness, it will pick up more numbers that are more favorable. Meaning, there will be a higher probability to pick numbers that are below 6 than above 6. If you put 1 here, the chance to get numbers below or above 6 are the same. When it's 1, it has the same probability to pick numbers below or higher. But if it's 2 or 3, the higher is the number, you will pick up more numbers in this range. You just change the probability. So why do you do that? You're just trying to see if you were wrong in your assumptions or your calculations. Still, you took it into account when you do the sensitivity analysis. So by choosing 3 here, I'm getting higher values, okay? That's why we got this one. We're getting higher values, okay? If I put 1 here, most likely I will get lower values. So this has helped me to show, even if I'm exaggerating to be optimistic, still I can't be so optimistic that the value will be 1800. Top, I can get about 1000. That's the objective of those two. Even if the range will be big, still, you know, I'm within that range between 400 to 1000, but very high, unlikely to be higher than 1000. That's the objective of those two in a simulation. Good. Now, if I want to know one last thing, if I want to know which parameters affecting the valuation the most, that's the objective of those little buttons I made for you. If you click only on the WACC, it does the same things, but instead of changing all those 6 at the same time, is keeping all the rest fixed, and you change only this one 100,000 times, only the WACC. So we see if you only change the WACC, it really does have a big effect. It's a range of almost 200. You see that? Between about 500 to, you know, it's a big range of almost 350. So the valuation is very sensitive to the WACC. Still, we are in a range. We checked all the range, so we are still, even we consider very low WACC, we still don't get to a higher valuation than 1000. You do the same things, keep all the other variables constant, and change only the short-term growth, give you the range. Again, here is the range is very small effect. So this is have effect of almost $20 to $30, but this one has effect of almost $300. That's much more, the valuation is more sensitive to the WACC than to my assumptions about the short-term growth. Some things to do about the long-term, how that affect the valuation. Okay, this is in the range of 50, not crucial. This is the strongest, this is the second sensitive one, and that will be the third one. We do the same things about the rest of them. You know, this one also has a big range, almost 400. We do this one. Here we have, that's not really that much, you know, plus minus, I would say 15. How much is 450 to 462? That's really not that much. Taxes don't affect that much the valuation as other parameters. Here it's very small, within $1 or $2, okay? So our valuation is not really that sensitive to the taxes, okay? But it is very sensitive to the WACC. It's sensitive to the EBIT, our assumption about the EBIT. It's sensitive to long-term, less sensitive to short-term, okay? That's really the conclusion from the sensitivity analysis. In fact, I just really dictated what you're supposed to answer in number 9. Okay, questions about that? This one I know that you're not familiar that much from other courses either. And I wanted to make sure that you do understand how to do number 9. Anybody? Questions? Need to repeat something? Good. Let's go to the last one, and then we'll try to answer a few questions about the exam if you have. But frankly, most of the questions for the exam, as I will see, I'll tell you, you have in the take a test, and I will go over that in a minute, okay? Let's move to number 10, which is the last one. What am I asking you to do in number 10? By the way, you have a recording of relative valuation. I went over that shortly last time, but the recording is really beautiful on relative valuation. And what am I asking you to do in number 10? In number 10, I expect you to pick up 3 comparable companies. You can find their names in the annual report of the company. It's the best place. You can look online or any publication that a company say, those are my best competitors. Annual report is excellent place. Take the 2019, the first half of the annual report is all discussion by managers. Look it up, you'll most likely find. So let's say we decided that company A, company B, and company C are best comparable companies. Here, what I will do, I will put P over E of those 3 companies. Where do you get those numbers? P over E, you can get them from Yahoo. Theoretically, the best way to do is calculate the earnings per share more correctly, pick it up from the annual report of those companies. They must report it, and you should use what is known as a diluted. I won't get into that. That's more accounting class. Take the diluted earnings per share, and then just see the price of the company stock in the end of the year. So let's say for the assumption, first company had $25 relative to the earning, the other one has 22, and the other one had 24. I just made it up. Okay, that's stage number 1. Collected data about comparable companies. Then I take the average. Now, somebody can ask, and it's a good question, why should I use the average or should I use the median? Now, if the numbers are close enough, okay, that's almost close enough. The median probably will be better in this example because those 2 numbers are very close. This one the average will be toward the 14, which will bias. On the other hand, the median, here the median will be 22. most likely better representation of what this company ratio is. So rule of thumb, if you see a big difference in the numbers, let's say this one was only 2, you really shouldn't use the average. You should use the 22 as the median, because this is most likely a outlier. And a median is an excellent statistics to overcome a very unusual low numbers or very unusual high numbers. The median, ignore them altogether. And it's a good statistics when you have this kind of situation. Let's just change that back. Let's say this is a, let's make it 21, just for the example. And in this case, it's good to use the average. It will be just fine, okay? That's stage number 2, calculate the average. Stage number 3, we implement it. What we need to find out is the earning per share of our own company. Let's assume it's $5 per share. So what's supposed to be the share price? That's really what we're looking for. It should be 22.6 times the 5. That's our valuation. That's valuation based on relative valuation. That's really, we calculate the ratio earning price over earnings per share for those 3 companies. We took the average, we looked at the earning of our own company, we multiply it by that number. This is really average P over E of those 3 companies, okay? Then we take this average, we multiply it by our own company earning per share, and therefore we estimate that our company share price to be $113.33. That's what I require you to do in number 10. Now, you really should have, if everything was really calculated right, this number should be close to what it's being traded. Otherwise, you have a problem. If we're getting such a big difference, and also in the relative valuation, you're getting a very small number, most likely then you have more confidence this is overvalued, okay? So this number is theoretically supposed to be close to this number, and those 2 theoretically supposed to be close to this number. Real life is never like that, and most likely you will see situation like that. Or if the earning per share was 20, you might get a higher number. This is, for example, would be very consistent. If the earning per share of our own company was 20, our valuation based on relative valuation, it is 453, very close to our estimation using discounted cash flow method, okay? Getting those 2 numbers very close to each other, and they are very different than what is being traded for, it tells you most likely this company has overvalued. It's overvalued. Questions, guys? Go ahead.
Yeah, if it's let's say really close to 1,800, what can we say about that?
Why not? That's the earning per share was 60. Okay, let's say it was 60. Okay, now let's bring you to a dilemma. Why do I have that big difference? Then I look at this. This distribution. I say, you know what? According to the discounted cash flow, if I push it, I get to 1,000. If that will be the number, I will still say it's overvalued. But I will write those 2 numbers, and I will have to come and try to understand why there is such a big difference. One reason might be that maybe one of those comparables are not that good. So I will dive in to make sure that those numbers are. Might be that this one really should be 20, and this one I was, and this one was 18. So I'm checking those numbers, and maybe this one the reason why there is big difference. Maybe my comparable companies is not that comparable to what I thought. That's one explanation. Second, as I said, that's why we do the range. So I won't look only on this number. So I will say, okay, I believe in this case it's about 1,000, 1,200 the most, but I don't think it is 1,800, okay? But you're absolutely right, you can get very different numbers from here to here, and you try to make up why the difference is. Most of the time it's because the comparables are not exactly comparables, and that's a problem. Good question. More questions, guys? Before we turn to the exam and talk a few minutes on question, or if you have specific question on the material. But let's conclude the issue about the assignment. Everybody, it's clear what do we have to do in the assignment?
I have one last question about the earnings per share.
Sure, go ahead.
I know if it's high or low, we compare it to the earnings per share for the other companies that we chose.
Correct.
Okay.
Yeah, excellent. That's really, we use P over E. E is the earning per share of the other companies. And the P is the price share of those companies, of each one of those companies. Very good.
Okay, so once I calculate my EPS, then I look at the other 3 companies and see if it's high or low.
Exactly. Just doing the step that I did right here. I have 3 companies.
Yeah.
In fact, if I were you, I would add another column, 2 columns won't hurt you. Just insert it.
No, but I mean, once I calculate my share price, the last
Right.
number.
So here we go. That's the way I would do it. I'll put here the P. Here I'll put earning per share.
Okay.
And I will do it for all the companies, okay? So let's say just making it up, okay? 200, okay, and 10. Let's give me that ratio, is that right? Let's do here 180, 360. I'm just making it up. Here I think I need 20. Okay? And that's the way I do it. And then this one is really calculated, by the way. This one is really this one divided by this one. Okay, the same thing's about this one. Let's do the other one. This one, I'll just make it up. I will just make up numbers, doesn't matter. Okay, and let's do plus this one divide by this one, and we get a number. Okay, so we get some number here. This one will be the average. After we have the average, it's really the average of those 3. Then I will, this one, the earning per share of our company. Fair enough? So I will put it here. I will take this one time this one. That's my valuation. That's what's supposed to be the share price of our company.
Okay.
That's the way I will do it, really. This way you don't get confused. Very straightforward. Even put it in your paper. Could be really nice. Good. Let's move on now for the last 15 minutes we have left, or a little more, to a question. Let me move to a little better screen. Let me move to, I will log in as a student. So we don't have like a, so I logged in as a student and I go back to the course and I will go here to the valuation. And here you really have, you have all the material, you have all the recording in the bottom. I apologize for last week. It was a really good session. It's really a pity that the Zoom didn't really convert the video. I had the original recording, but it had to go through a process of conversion. And unfortunately, there was something went wrong in the Zoom. But I did upload it. The most important part of last week is the relative valuation, and recorded it. And you have the whole explanation of what we did last session. So this is really recording on relative valuation. So you have all the videos. You have also for every section, I added questions. So take a test. It's a very good way to study for the exam. Go over it. It's really good material. Many of the questions, you know, you have the answer. You click on that one, that's wrong. Then you know this is the right one. You study by taking the test, kind of taking the test. But you really, this is built on helping you to study. You take another, let's say this one. You think this is the right answer? No, this is wrong. Try this one, it's wrong. Try this one, this is the correct answer. Now, look at the question and study from it. Now that you know what the correct answer and you tried your best, at least now you know the right answer and try to understand why this is the right. This is excellent tool to study for the exam, okay? I try to put as many as I can. I might even add more questions in the next few days so you'll have a better way. Growth, the same things you have also here. Take a test, you go into here, you have several questions. Some of them I took from previous exams. You know, in a steady state, we use the marginal tax rate, yes. The expected growth rate of GDP, yes. ROIC equal to what? Yes. So that must be the right answer. Okay, this is an excellent review question. We just went over all of that a few minutes ago. But this is really a good questions. If I put it as an open question, I might put this one as an open question, and I will ask you, express your opinion about that we use marginal tax rate, we use the expected growth rate of GDP for the growth, and we use ROIC equal to WACC in a steady state. Why? Then you should really explain that if this assumption don't exist, if ROIC was higher than the WACC, that means this company going to go up in value to infinity over many years. Since we're using Gordon equation, that's the only reasonable assumptions to make. If this one will be lower than this means this company will shrink over time, and in 100 years, it will definitely will disappear. Okay, so this is the only sensible assumptions to make. About growth, that goes in line with this one, by the way. Same thing, same argument for the one. How about marginal tax rate? Because we believe that eventually not believe it's really also true in real life, most of the time, unless they get special subsidy, most of company, they can postpone taxes for several years, but not forever. So in a steady state, eventually they will pay the taxes, and they eventually will pay the marginal tax rate, okay? In the short term, they might be able to postpone taxes. That's why we use the effective tax rate. So that's complete answer to a question like that. If I take a question like that, turn it to an open question, okay? Most of your question will be, if not all of them, will be open question. I like open question because if I see a student that understands most of the stuff, I give him most of the points, even if he wasn't exactly right. In a multiple choice, when you have to mark only one answer, it's too harsh on the student. I don't have that flexibility to be, to be flexible for when I'm grading your test, okay? So please do go over those ones. Those are really good tools to study the material. In addition, as you know, you have all the material here, all the slides. If you miss something, just look at the video. You have the video for everything. The beauty here is no PowerPoint, no nothing. It's all online. You can use any tablet or whatever convenient for you. You don't have to download any material. This one, go over this one. I will provide you with this equation, yeah? This equation will be in the exam, I will put it. But do understand the meaning of every element. Do understand what is the numerator is, okay? What are the components? This is the EBIT, that's the operating income. This one is really, I many times like to say, this is like the cake that I'm giving to 3 children. Who are the 3 children? The first child is the interest. I have to pay interest. But here we don't account for interest. Why? Because we're looking at the value for the shareholders and the debt holders together. So the first child, we do not subtract the interest. The second child is the tax authority. They want their piece in the profit. So that's why we subtract the tax rate from the amount. So this one is how much cash, more or less, we have for the debt holders and the equity holders. Then if we want to grow, we cannot distribute all this amount. We must keep this percentage. So G over ROIC, it's the reinvestment rate. This is the percentage we must keep so we can grow in that percentage. Okay, so this is the reinvestment rate. You must know that, okay? And the bottom here is just simple calculation. What is the value of a company that in the first year giving me this cash flow and it's growing at the rate of G, the net present value is equal to this cash divided by WACC minus G. Okay, that's a complete answer if I ask you to explain this equation. Okay, the reason we subtract G is because it's growing over time, so the value is higher than if it didn't grow. If there was no growth at all, this one go away. We don't have all of that one. Well, that one will go away. That will be the EBIT times 1 minus T times the WACC. That's the only things will be. That will shrink totally if there's no growth. Okay, and we did a lot of examples of that. So please do look at that one. You have a little simulator to see how it. This one is excellent, excellent questions. Go over that. I might take this one, put a screenshot of it, and just change the numbers here and make you fill those ones up. And you know, we have covered this kind of a question in the class, and I usually will direct you to start from the indirect method and then go to the direct. And I also told you in class, you can utilize, when you know the debt value, you can calculate the interest, something you need here. You don't need the interest here, but you do have to have it here. But you cannot calculate the interest before you know the value of the debt. And you cannot know it directly here. So that's why if I give you this question in the exam, do this one first, calculate the debt, take the debt times the interest, you can find the interest. Fair enough? I'm emphasizing things that I might trick you with. So don't get tricked, okay? Okay?
I have a question.
Yeah, go ahead.
Are you going to upload sample questions for the relative valuation section? Like in the take a test right now, there's no questions.
Exactly. In fact, I have already note from the previous session, class I had. I do. Yeah, in fact, I have already email from a student, ask a student to remind me. I will, definitely will.
Okay, then also, you said last week there's a sample exam, like last year's exam on the website. Can you show us where that is? I just don't see it on my end.
Let me see. Yeah, why not? That's good. IDC. I recall that I uploaded. Let's hopefully I will find it myself.
Oh, it's on.
I usually like to put it on the top.
I was just looking at the Academy study. Maybe that's why.
Yeah, I think this is why. By the way, let me re-emphasize. You're uploading your assignment to the Moodle. The Moodle is the tools for assignment. Yeah. That's why I put it here, okay? And it should be here somewhere now. Where did I put it? Maybe in the bottom? Nope. Introductions, maybe in the bottom here. An example of last year exam with solution. You see that? Usually I put it on the top. I don't know why I put it here.
Yeah. No, I was looking at the Academy study. That's why.
No problem. Yeah. I think also the session today, we basically went over stuff we did last week. So you take it together, it's come out to be okay. Let me see you.
Thank you very much.
Thank you, guys.